Okay, what we're going to talk about today is building a financial foundation. And whether I'm standing up in front of a large group of people or basically sitting down with someone at a coffee shop, I usually start off the same way every time. My name is Ken, and I'm a financial consultant, and I'm very happy to be presenting some information that a lot of people probably don't know about. And I hope to educate you on some things that are very important. And those things are about money, finance, and how we can move from the 95% group into the 5% group. Because in North America, 95% of the people live paycheck to paycheck, and 5% have what we would call a good lifestyle. 95% of the people in North America live paycheck to paycheck. And why do they live paycheck to paycheck? We're going to discuss some of those things while we're talking about this presentation and working through this presentation. And hopefully it will open up your eyes as to some options that you may have in your life and some things that you can do to move yourself away from that 95% group. Because the best thing you can do for your family and for yourself is to exercise some discipline and look at things from a different way. And what I mean by look at things from a different way, Albert Einstein, I think, said it better than anybody when he said, the significant problems that we face today cannot be solved at the same level of thinking when they were created. I'll let that sink in. But understand, we have to start thinking out of the box in order to move on with our lives financially and build a financial foundation. So there are going to be 4 things that I'm going to stress over the course of this presentation. And hopefully you'll pick up those 4 things and understand, the significance of them. So let's go ahead and get started. You can build a proper financial foundation. What are your challenges? To protect your family, your life, your health, and your disability. Most people don't realize it, but you're going to have a higher chance of becoming disabled than you will dying. And so disability is becoming more and more of a popular discussion topic these days because, like I said, there's a higher probability of you becoming disabled than dying from, say, an accident or something like that. To reduce your liabilities and get out of debt sooner. There's nothing more restricting than debt. And we'll talk about that a little bit later in terms of how we can, work on some things to get out of debt. So understand that debt keeps more people in bondage all over the world than any other thing. Dealing with constant change in your job, career, or business. Technology displaces people. We all know that. We all understand that as any time something shifts in technology, there are going to be winners and sometimes losers. For example, the classic example that people always use is the vinyl record industry. When vinyl records were replaced by CDs, it took out almost 90% of the whole industry. Yes, there are still some vinyl record companies out there that are still making those records, but the majority of people went from vinyl records to CDs. Well, there was a couple things in between that and things like that, but the bottom line is they went from one technology to another, and a whole industry of people had to retool or find something else to do. And now the folks who make CDs are looking at the same situation. A lot of stores aren't even making CDs anymore, and a lot of computer companies are shipping computers now without CD players. So technology constantly is changing, and there are going to be winners and losers. So either you retool yourself or you basically suffer by not retooling yourself and being prepared for the changes that happen in this world. And the other thing is very important is living long with adequate income or without adequate income. Most people don't realize it, but the largest majority of people in this country are over the age of 70. people are starting to live longer because of changes in technology and changes in healthcare, and the fact that we can keep people living longer and healthier longer. And what does that mean? For a lot of people, they run out of their savings before they're ready to run out of life. And so we have to structure programs now based on the fact that we're all going to live to maybe 85 to 90 years old, or even 100. And so if you're finishing your work at age 65 or 67, you still have 30 more years that you're going to have to live. And so we have structured programs that will help you determine, okay, how long are you going to live? And with that information, what do I need to do financially to keep myself going? So we'll be talking about that as well. What are some of the solutions that we have? You must protect yourself, okay? Protecting yourself first, and then getting out of debt, then setting up an emergency fund, and then after you have all those three things taken care of, where you have an emergency fund of between 3 to 6 months, so if something happens to you or your job, you'll be able to sustain your family to a period of time that you will be able to find a new job or make changes in your family economically. And then finally, having investments. There's investments that are good and investments that are bad. We will talk about what those investments are and how you can build wealth safely. You know, a lot of people talk about, the markets and the fluctuations of the markets and things of that nature, where there are strategies that have been put in place that a lot of people are now starting to realize that you can actually grow your income without the risk of losing it. And so we'll be talking about those. So one of the things I wanted to get back to, and one of those themes of the 4 things I wanted to talk about, is what is the best way to build wealth? Number 1, it's called pay yourself first. And we'll talk about that in a little bit. But number 1 is pay yourself first. There's 3 more that I'll be talking about in a little bit. So what are we talking about doing is making money, saving money, growing our money, and protecting our money. And that is a proper financial foundation. So we're going to get into some concepts that you may be familiar with or you may not be familiar with, but we're going to talk about a couple of them right now. And the first one is the wealth formula. And the wealth formula is a basic formula of how we can create wealth and how we can figure out what we need to do to create wealth. Because it's a simple formula. It's based on this. You have to have money. You have to have money, and you have to have time for that money to grow. Albert Einstein, we're going to talk about a couple of his theories later on, but he came up with some very interesting information about how money and time work. And then you have to have a good rate of return on your money, because there's this thing called inflation. And if you're not getting at least 5% return on your money, then you are not keeping pace with inflation, which means the economic power of your money is eroding. And so most people who don't understand that, if they've got money sitting in the bank and they're only getting 1% interest on that money, well, these days it could be less than 1%, then they're actually losing the buying power of their money with time. And so finally, the other thing is taxes. We need to figure out a way to lower our taxes as much as possible. And so once we put those things together, we have a formula to create wealth. And you can build a successful financial future if you're willing to have discipline and let time take care of money. Now, let's look at the X curve. And the X curve is something that opened my eyes when I first saw it, because it talked about something that was very important. And that is, you're not getting any younger. Okay, the 2 lines on the X curve basically look like this. You have the decreasing line, which is the blue line, which is the law of decreasing responsibility. And you have the other line, which is the law of increasing wealth. And you have moving from younger to older. And what happens is this: as you're young, you have a lot of responsibilities in your life. You have payments to make on the mortgage, you have kids, you have all these different responsibilities that you have to meet on a regular basis. But as you get older, some of those responsibilities start decreasing. And as they decrease, you are no longer spending as much money on those expenses and things that you were in the past. For example, after a certain number of years, your mortgage is starting to be paid off. You don't have a big car payment anymore because you may have a smaller car, or you may have paid the car off and it's a good, car that's going to last a long time. The kids are out of college and on their own and doing their own thing. So there's many things that will start to allow you to increase and decrease the amount of expenses that you have. On the other side of that is the law of increasing wealth. And the problem is this: most people never start looking at saving money. And if they do, most of those people start looking at saving money when they are older and have to play catch up. And the problem with playing catch up is simply this: you're not allowing money plus time and the rate of return, which is a part of that formula, to work for you. Most people get to a certain point in their life and a certain age in their life and realize that, hey, I don't think I'm going to have enough money to retire. And that's why so many people that you see over the age of 65 are working at places like Walmart and other places like that, because they don't have a choice. Because A, they probably did not save enough money when they were younger, or B, an economic catastrophe happened in their life, such as a market crash or something like that, which forced them to basically go back to work. And the way we build our financial foundation for people, you don't have to worry about market crashes. And we'll talk about that very soon. You must take responsibility and take care of your family and all your responsibilities early while you're still building wealth. So as you move from left to right, as you're getting younger, from younger to older, you must understand that you have to have the discipline to save money. Now, let's get back to Albert Einstein again. Albert Einstein came up with a formula called the Rule of 72. And if you never heard of this formula, the banks that you have credit card balance on, they have. And they use it against you every day. And what this is, it talks about the power of compounding interest. So what we're going to do is we're going to take 3 examples of how the Rule of 72 works for you, and then 1 example of how it works against you. And it looks like this. Let's take a person that's age 29 years old, and they have $10,000 sitting in some financial place. And let's say that they are getting a 4% return on their money. So at 4%, what the Rule of 72 says is take the interest rate that you have, divided by 72, divided into 72, and it will tell you how many years it takes for that money to double. 72 is the only number that this works for. So let's take a look at our example. At age 29, this person had $10,000. They were getting 4% return on their money, which means every 18 years their money would double. So at age 47, they had $20,000. At age 65, they had $40,000. Second example, let's take that interest rate of 4% and double it to 8%. And if we double it to 8%, look what happens. At age 65, they have $160,000. Now, they doubled the interest rate, but did the money double? No. The money basically quadrupled because of the compounding effect of money. And that's why it's so important that you let money compound over time. Last example. We get a 12% interest rate, so we moved up another 4%, and look what happens to the money at 12%. Every 6 years from age 29, the money will double. So at age 65, they have $640,000. Now, this is an amazing understanding and illustration of how money works. You have to let money work over time and let money compound itself. Now, let's take one more example, that if you have a credit card and you're paying 18% interest rate on that credit card, how many years would it take for that balance to double? That is correct. It would take 4 years. You take 18% into 72 and you get 4. So if you have a credit card balance out there, every 4 years that balance would be doubling. And that's why banks don't have a problem with you making minimum payments, because they know over time you're going to get back a lot more money based on the rule of 72. And that's how the rule of 72 will work against you if you are not being disciplined and you are letting credit card balances get out of control and paying high interest rates on them. Most people never get out of credit card debt because they have never learned how to roll up credit card debt and how to financially fix themselves. But we'll teach you that in our workshops. We have workshops and things of that nature that allow you to come in and learn all these things about money so you'll understand what you need to do to get yourself in debt. Get yourself out of debt. Let's look at an example of saving early versus saving late. We have a person on the left, Mr. Start Early. They put in at age 25 $3,600 a year, and they only did that for 6 years. And their friend did not start early, but they started at age 32. And as you can see, it's a very graphic example of how money and compounding works if you give money the amount of time to grow. Although at age 48, Mr. Start Late basically had a few thousand dollars more, look how much he actually paid into the program. Okay, he put in $61,000. Mr. Start Early only put in $25,000. So you must understand that it's important to see how valuable time and money work together. I cannot stress that enough. Let's say you're saving $300 a month at 8% for 30 years. You're going to have about $447,000. You take that same 30 years, double the amount of money that you have, and you're going to have $894,000. Now, can you cut down on the following? Sodas, cigarettes, lattes, cable TV. I'm going to stop right there and say no. We're not asking you to give up your lifestyle. We're asking you to start considering other ways to increase your income. Because as adults, nobody wants to give up anything. You're an adult, you have your lifestyle, you're locked in. Unless you're doing something unethical and really bad, then you want to keep your lifestyle the way it is. And so why not look at alternative ways to increase your income? And that way you will know that you don't have to cut, because nobody wants to cut things, let's face it. So understand that you'll have to look at other ways to create income, because nobody wants to cut, who wants to cut their lifestyle to save money? The best way is to increase your income, and that is very important. Now, the second thing that I was talking about, the first thing was pay yourself first, and now the second that we're talking about is, you saw it earlier, and that is developing an emergency fund. Make sure that you start saving 3 to 6 months worth of income in case of an emergency. So that's number 2 of the 4 things that we have on our overriding theme. Remember, you need to save money. Discipline is very important. Now, we're talking about growth, safety, tax advantage, and protection. And so we ask people all the time, 4 questions I'll ask when I sit down with someone on a one-on-one, or when I'm standing up doing this presentation. I'll ask them a simple question. 4 questions. What are you going to do to plan for your future? can your money grow to achieve your goals? In other words, are you getting a rate of return on your money that when you sit down with someone and project out where you want to be in the future, you're going to be able to get there based on what your money's doing? You know, a lot of people that I sit down with, they talk about, you know, they got money in the bank or they got money in a CD or something like that. And I say, well, that's not going to help you get where you're going, because you're actually losing the power and the value of your money with your money being in those places, because the rate of return doesn't keep pace with inflation. Is your money safe? And when I talk to people all the time, I say, well, if you're playing in the mutual fund and the stock markets and all these other, you know, crazy, sexy things, is your money safe from a crash? Is your money safe from a 2001 or 2008? That is a question. If you're in the market and someone is managing your money, the answer to that question is usually no. You are not in a position where your money is safe. Someone is handling your money, and you're betting every day that they know what they're doing. Does your money have tax advantages? We'll talk about that very soon, but the bottom line is tax advantages is where the wealthy people play. The wealthy people put their money in places where there's tax advantages. And like I said, we'll discuss that a little bit later. And does your money have the proper protection for your family? If something were to happen to you tomorrow, will your family be able to keep the lifestyle they have for a temporary or a long-term basis and go on with their lives? So what are we talking about? Talking about reducing your debt, learning how to pay yourself first, making more money, building up equity, and then finally preserving your estate. In other words, making sure nothing happens to you or your money in economic conditions. And that's how we build, and we build it with confidence. Now let's talk about the tax issue of money, because everybody wants to talk about taxes all the time. Taxes, if you didn't know, is the largest expense that you will pay over the course of your lifetime. Okay, the largest expense you're going to pay over your lifetime is taxes. So let's go ahead and take a look at what that's all about. Looking at the left column here in the United States, this is where most people put their money. And there's three categories that they use to put their money: tax now, tax later, and tax advantage. If you're in a tax now simply means that if you have your money in a checking account, savings account, stocks, bonds, mutual funds, and things of that nature, at the end of the year, that institution is going to send you a statement that says this is the taxes that you accrued over the course of the year, and you'll pay those when it's time for taxes in terms of the gains. Capital gains, that's what you're going to pay, and you pay that what's called tax now. Tax later is what I like to refer to as the middle class trap, because most people are in this who make up that 95% because they think they're putting their money to work for them. And if you're in a tax later situation, let me explain something. In 1978, the United States government got together with Wall Street bankers, so you know this may not end well, and they said, in the year 2030 or close to it, we're going to run out of money for Social Security. Wall Street stepped in and says, well, we have an idea. We have a plan. We'll put together a plan of action that will allow people to start saving money, and we'll say that money is taxed later or tax deferred, and then they can be taxed once they retire. That way, you, U.S. government, will have a tax base. And so what happened in 1978, these qualified plans started, and people started putting their money in 401ks, 403bs if they worked for governments, IRAs, and all these other programs that were what we call qualified plans. Now, most people don't know this, but when they are ready to retire, those qualified plans step in and they say, okay, it's time for your taxation. And when they put the plans together, they realized that two things were going to happen. The taxes were not going to be determined until that person retired, and that person was not going to be able to touch that money without penalty until they were a certain age. And so when you look at the tax later, what I call the middle class trap, let's say, for example, you have $500,000 sitting in your 401k that you've accumulated over the years. The government will step in and say, at this point in time, we're going to take 30% of that. And then you walk away with $350,000 for your retirement, even though you worked hard to earn that money. Because it's a tax-deferred plan, they can set the taxation on that, and they'll let you know. And so most people don't realize that they're going to lose a large percent of their income in their retirement to taxation, but also it's been estimated that up to 30% of a person's wealth is basically paid out in fees and maintenance on those plans. So be careful where you put your money. Now, tax advantage, if you want to replace that word for advantage for free, you could do that as well. But this is where the wealthy 5% play in this country. The 1 to 5% play in tax advantage programs because they don't want their money taxed excessively. I don't have a problem with police coming to take care of my neighborhood, the roads being good to ride on, and the military there to protect us. And that's what taxes should pay for. But we have learned through proper money counseling that you don't want to pay more than your fair share of taxes. Well, the wealthy 1 to 5% have learned this lesson very well. And those other programs that you see there that are basically tax advantage, or you put your money in and you take your money out tax-free. And of all those programs there, the number one program that people are using to protect and save and generate and accumulate wealth is life insurance. Most people, when you say the word life insurance, they have an opinion about it being a death benefit. Let me make a clarification right now. Life insurance, for those who are educated, is a living benefit. And the living benefit are through policies and programs that are used to basically protect your money and your assets tax-free. And when you're ready to retire using life insurance, you'll see that you'll be able to retire tax-free. Understand, life insurance is not an investment, it is a financial strategy that people use to accumulate wealth. And I will show an illustration of how that works right now. We're going to talk about an insurance policy that's called an Index Universal Life Policy. And it is one of the products that we work with people on setting up and helping them create long-term savings. So in this initial policy, you'll see that this person who is 34 years old is paying $500 a month as a what's called a monthly premium, or $6,000 a year. And they basically wrote that to show the equivalent of what you use when you're putting in max amount into your 401k plan. Okay, if you've got a 401k or 403b, $6,000 or a little bit more or less, depending on what kind of position you have, is the actual number that you're going to put into your account if you're maxing it out. And so what it would look like then is $6,000 per year is what they're paying for their premium outlay. They would have a death benefit of $500,000. So if something were to happen to them, or their family would get immediately $500,000 or $500,000. That is the what we call the face value of the policy. Okay, the monthly premium is $500,000, which is $6,000 per year, and the death benefit is $500,000. Now let's move this down, because we are putting our money away to the tune of $6,000 a year. And so at age 44, 10 years into the program, you'll be able to see that there is a cash value that's been generated of $61,000. Okay, $66,000 is what has been put into the policy. And so you pay $66,000, and now 10 years into the policy, you've accumulated $61,000. That's $61,000 that you could do with whatever you wanted to do. If you wanted that $61,000 at that time or any time before that, anything that you're accumulating, you can take that out. It's not good money management, but you do have that option. So at age 44, 10 years into the policy, you can see that they're starting to accumulate some income. At age 51, 17 years into the policy, you can see that they put in $108,000. The policy value now is $158,000 in cash value. And so we still have money going in and accumulating income. Now let's take a look at age 60. 34 years old when they got started. Now they're at age 60, and they have put into the policy $162,000, and they now have a cash accumulation value of $352,000, which means they've almost doubled their money. They have a death benefit of over $700,000 because they have what's called an increasing death benefit policy. So let's move on to when they are ready to retire. 67 is a retirement age now. So at age 67, they've been putting money into this policy for 34 years, and they put in, over those 34 years, they put in $204,000. $204,000 is what they put in. They now have in their cash value account $601,000. So they've almost tripled their money through this program. And they have a $1 million death benefit as well. So one of the things that we do is we work with folks to structure how they want to have their money come out of that cash value when they're ready to start taking money out. So at age 67, we worked out that formula with this person. And so at age 68, they want to start taking out over $3,000 per month. So they're taking out $37,000 per month. So what happens is this. In the insurance business, the money goes first in, first out. This is a very important concept, which simply means this. When you put your money into what you paid for, you're going to get that money back first. So as you can see through this illustration, they put in the $204,000. They're starting to take out $37,000 per year, and it's coming out of the net premium outlay, which is what they put in. And that's coming out tax-free. Okay? So let's move on down to age 78, and as you can see that, well, let's look at 73. They start taking what's called a loan. They start taking out a loan from their policy, and that reduces the cash value for a period of time, but not that long. So in other words, you are going to do something very important. You're going to start taking money out of your policy. It's going to come out tax-free. You're going to take loans on that, which is at a 3% rate, but 2% goes back in automatically, which means you're really paying 1% on the loan that you took out from yourself. And understanding money management, that is a better deal than you could imagine. So let's stretch this out one last time to age 100. They made it to 100 years of age. So from age 67 to 100, they have been getting $37,000 per year. This is where it gets very interesting that people need to understand. Their net premium outlay is $1 million, which means they have taken out $1 million out of the policy. But how much did they put in? They only put in $201,000. And so this is a very important concept to understand about insurance. It is a great money management strategy. They put in $200,000, but they were able to take out over $1 million tax-free. And at age 100, they would get $176,000 back from their death benefit, which automatically rolls when you are 100 years old, unless you structured your policy to go to 121 years, which is sometimes we do that just to illustrate how the money works, and that it will start accumulating again over time. Once you stop taking money out, the money will start growing again. So in other words, this is a policy, one of our strategies that we use to help people grow their money long term. And that is why we emphasize that it's very important to start growing your money early instead of late. So, where are we with our managed growth in those 4 questions? Let's take a quick summary. Our program, we have growth. And we have a growth program that has what's called a ceiling of 15%, which means if a good year happens in the markets, because we have an index to work with, the most you'll be able to get is 15%. So if the market went up maybe 18 to 24%, you're still only going to get 15%. And that's good for a reason. Okay? We have safety, and that is a guarantee. 0.75. 0.75% is what we pay even if the market were to crash. In 2008, when the market crashed 40%, people who had their money in this financial instrument still made money during that crash. In 2001, when the market crashed, people who had their money in this instrument still made money. There's a tax advantage piece of that, which I showed that over $1 million was taken out tax-free in the form of withdrawals and loans, and they're tax-free. And then you had that protection of $500,000, which grew to $1 million of death benefit in case something happened to you. These are 4 important things that will help you manage your life and manage your income. It's very important that you understand that you have to have growth, safety, tax advantage, and protection. And that's how wealthy people take care of their money. When someone says wealthy people don't lose money, this is the reason why. Because they put their money into financial instruments that will allow it to grow. What are some of the challenges that are facing us today? You have to increase your cash flow. Bottom line, make more money when you can. Have multiple streams of income. Make hay when the sun is shining. Cut down your expenses. It's not how much you earn that counts, it's how much you keep. And that's how we go into number 3 of those 4, and that is you want to lower your tax burden as much as possible. Because if the biggest expense you're going to pay over the course of your time is taxes, then you need to develop a strategy to lower the amount of taxes that you're going to be paying. So what do we had? Pay yourself first, develop an emergency fund, and number 3 is lower your taxes as much as possible. Now back to those challenges. Reduce your debt and liability. Very important that you get out of debt, because debt will never allow you to grow money. Understand how money works. Most people work for money but never let money work for them. Well, here's an opportunity to allow you to let yourself learn how money works for you. Have a financial goal and a plan for the future. Most people spend their time planning what they're going to do for vacation, or what they're going to do after for the weekend, and never plan a goal for their life financially. You have to figure out what you need to do to make your life work for you financially, because everybody has access to the same information. 95% of the people live paycheck to paycheck because they never create a plan of action. Embrace change and expect to succeed. Be certain of the uncertain times. There's going to be challenges in your life that's going to happen. That's just life itself. The idea is this: you have to learn how to work through those challenges and expect a good outcome. And that's called controlling your future. Now, one of the things that I talk about a lot is this: 95% of the people live paycheck to paycheck and they never get out of debt. Well, if you're going to make some changes in your life, you're going to have to do some things differently. If you would like to get out of debt, You need to increase your streams of income. That is the only way that you'll win the financial money game, is to have more than one source of income. The number one threat to anyone is having one source of income. Because if you only have one source of income and something happens to that, that could put your family into financial straits. So why not look at creating multiple streams of income? Well, we have a program. If you want to increase your income, you can step into one of the most lucrative businesses in the world, and that is the financial services industry. It is the most lucrative business in the world. Why? Because we are where the money is. And we have a very simple formula. Let's take an example of how the money can work for you. We have a person that's 34 years old, and they're only spending $200 per month on a policy. Okay, they're buying insurance like we showed earlier in the illustration. Instead of $500, they're only paying $200 a month for a basic policy. Same as that other illustration showed. They're 40 years old. Now, they're paying $2,400 a month. When you come into our program, we want to get you into what's called the associate level. And we do that by this program called Join, Own, and Share. Where you join our program, you own the product, and you share with other people. So at the associate level, you're going to be writing business at approximately 45%. So 45% of $2,400 is $1,080. So you take $1,080, and let's say you do that 4 times a week because you're only doing this part-time. 4 times a week would give you a monthly income of $4,300. $4,320 is your monthly income if you share this just 4 times a month, or $51,000 per year. Now, let's say you become what's called a senior marketing director. At the senior marketing director level, you're promoted from that 45% to 80%. So you're writing business at 80%. So that same $2,400 times 4, you would actually be earning $7,600 per month, or approximately $92,000 per year. These numbers may sound big to you, they may sound small to you, but wherever you are, we could set up a program based on what your financial goals are and help you reach that. Now, as an active partner in teaching people and training people how to build this business and build a great office, as a senior marketing director, you can extend your income by getting overrides based on what the people in your group do. So what you do is you help 5 people write 1 policy per week, just like you're doing. That would give you an override of $16,000 per month. Add that in with your $7,000, and you're looking at an income of about $23,000 to $24,000 per month. Understand what Bill Gates said. If you're born poor, it's not your fault. It's not your mistake. But if you die poor, it is your fault and it is your mistake, because we all have access to the same information. And no matter what you do, it's all based on the decisions that you make. Now, what I want to talk about is getting started. Very simple. You get what's called an associate membership agreement for $100. You get a number, and that code ties you into the system and allows you to start talking to people about this program. You want to get a state insurance license wherever you are. Whatever state you're in, you got to take a 60-hour course. It really doesn't take that long, but it's a state licensing course, so you can get your state license. Once you pass the course, you become licensed, and then you can start creating income. There's a business starter kit that gives you all the reference information that you need to get started in business. You'll get a manual, you'll get other marketing materials and things of that nature. And so you'll be able to go out and help people. Now, one of the things I want you to understand as I close is this. You start a business for $100, and it doesn't seem like it's a lot of money, and it really isn't. So why not take a chance at becoming successful financially for just $100? When I looked at this program and I saw the income potential, and when they told me it was only $100 to get in and get my license, I was like, whoa. I've been involved in other businesses that have cost a lot more money than that. So here's the deal. Talk to the person who invited you to see this video and this presentation, and let them know that you're ready to do this, because it works. It's a good, honest, ethical business. And in closing, before I give out my last of the four, in closing, I want to say this. There's this thing called pattern interrupt. And what pattern interrupt is all about is this. When I say 95% of the people in this country live paycheck to paycheck, it is because of their thinking. Now, what you have just experienced is what's called pattern interrupt. I've done a presentation and showed you an option for your life that can make a positive impact on your life. You may be excited about what you just saw and the potential that it can give you financially, as well as building a long-term savings program. Pattern interrupt says this: my brain wants me to stay in a certain level of comfort. And so by staying in a certain level of comfort, I basically won't do things that I need to do to get the things that I may want. So pattern interrupt would say, I like what I see. Monday afternoon, Tuesday, Wednesday, you saw it a few days ago, and all of a sudden your brain has readjusted back to normality, and logic kicks in with the brain that says, we want to stay comfortable, we want to stay where we are, and so you don't take action. The 5% of the people in this country that have created wealth have taken action. They have moved past pattern interrupt and said, I'm going to take action. And that is what I ask you to do. Is you're excited, you may have an emotional high about what you've seen, you have a way out financially. 95% of the people in this country choose to be poor. And someone told me period of time ago what poor represented. P-O-O-R. Pass over opportunities repeatedly. The wealth in this country is held by 5%. 95% of the wealth in this country is held by 5%. And so if you talk about the rule of 72, let's also talk about the rule of 95 and how you can get out of that 95% and move into the 5%. I really enjoyed sharing with you. And number 4 of those things that I talked about is you must remember to create multiple streams of income. No matter what you do, you have to create multiple streams of income, because that is what successful people do, is they have more than one source of income. So I look forward to working with you. I look forward to hearing about your success in this great business. I look forward to you becoming a financial industry champion. And I hope you've enjoyed the information that I've shared with you. And I hope that it will move you to take some action and do some things with your life.